Hi, this is Krishna Merchant and thank you for joining on Mint Money Minutes. The market regulator Sebi came up with guidelines around 9 months ago whereby the investment advisory firms have to get themselves registered with the market regulator. And since then, some advisory firms have already registered. We have with us Kaizad from the mutual fund, as a mutual fund editor from the Mint Money team, who will tell us what does it mean for the investment advisory firms and what it also means for the investors. Hi Kaizad, thank you for joining us for the Mint Money show. As you mentioned that the SEBI had come up with these guidelines around almost 9 months ago. Since then, how many investment advisory firms have registered with SEBI for the same?
A total of 11 individuals and firms have registered with SEBI. So basically, you can either be an individual or you can be a firm to get an investment advisory license. So as of August, to answer your question, as of end of August, there have been total of 11 individuals and firms.
Also in your story you mentioned about the cost and the fee structure. SEBI has said in their guidelines that the investors will have to pay up for it. Can you elaborate on what does it mean for the investors?
See, earlier what used to happen was that a distributor, any financial advisor or distributor used to get commissions and fees from both the product manufacturers, the mutual funds and insurance companies, and also from investors, their customers. But now one of the main conditions, as you rightly pointed out, is that they have to take fees only from the investor and not from the manufacturer. That is not from the mutual fund house and not from the insurance company. So that's obviously one of the main criteria.
Also, Kaizad, you mentioned in your story that for the investment advisory firms, their advisory business and distribution business has to be maintained at an arm's length. Can you elaborate on what exactly an arm's length means for the investment advisory firms?
See, earlier, what used to happen was that a distributor used to take fees obviously from both the investor as well as the product manufacturer. So what used to happen was that, there was a fear that there is a conflict of interest, that whoever pays the highest commission, those products were actually being pushed by the investment advisor to the client. So now the precondition obviously is that there needs to be an arm length. So you either earlier what financial planners used to do is that they used to take fees from both the parties. So now you are an advisor. So you are supposed to be, your responsibility is supposed to be only for your client and for their advisory needs. Okay. So, you had your distribution business earlier. That distribution business now has to be separately, that is, be segregated into a separately identifiable unit. Okay, there shouldn't be any conflict of interest between the two departments. And any product which is advised by the investment advisor to the client, there should not be any obligation for the client to buy that product. Okay, and whoever is in charge of that division has to be a very separately identifiable division, which is what the arm's length definition means. But there is no definition of arm's length. SEBI has not clarified what an arm's length definition should be. So that's open for interpretation. So in which case, what happens now is that investment advisors can sort of have their father or mother or spouses as let's say in charge of one business, and investment advisor is in charge of his own investment advisory business.
Also, Kaizad, another thing which you mentioned in your story was that the cost structures would now become different for the investment advisory firms. So after these SEBI guidelines, is it becoming a sustainable business model for them? Can you share some light on that?
It's going to be a little costly, obviously, for investment advisors to run the business as of today, because it's not easy for them to sort of get investors to pay for the fees, and the compliance costs are also high because they need to invest in all sort of CRM softwares to maintain their records and all that. And you need to have an auditor, you need to have all sorts of compliance costs. You need to have a compliance officer also. So obviously, to run the business, it's not going to be a very cheap thing. Obviously, it's expensive. So yes, initially the costs are going to be high, but that's the way to go ahead in the future, because once you get that kind of a certification that you are an official investment advisor, it adds to your credibility. An investor kind of knows that this is some kind of an official investment advisor who's coming to me. So it's in their best interest to sort of comply and become an official investment advisor.
So as Kaizad, the mutual fund editor, pointed out that the SEBI guidelines are investor friendly, and in the long run it is good for the investors because it will prevent any kind of mis-selling that was happening. Also, the only ambiguous part is maintaining the business, that is the distributor and the advisory business of the investment firm at an arm's length. That is all for today. Do stay tuned to Mint Money Minutes for more stories. Thank you for joining us.